right, welcome everybody to Live Valuation. I'm Minus Moriarty, and today we're going to be taking a look at TSN, ticker TSN, Tyson Foods, a company we've definitely covered a few times on the channel before, and it is a personal holding of mine and has been for some time. So that can be fully upfront and fully aware for anybody who is relatively new to the channel. Before we do get into Tyson specifically, taking a look at our watch list that we have here. Oh, here, hold on. I have to adjust some sound settings. I can hear I'm getting a little bit of feedback coming through. I don't want that to be picked up by the mic, although I don't think it would be. It's pretty quiet, but either way, it's going to annoy me. Anyway, so here in our watch list, we can see a lot of the same stuff that's been relatively near the top for some time is still there. Smith & Wesson, Interfor, I've been buying more of both of those, readjusting various other things. Nuke gets in the chat. Hey, how's it going, man? Good to get you up in here. Fine. Oh yeah, no, sound output I assume was fine. It was my headphones. I could hear myself coming out of my headphones. It probably wasn't going to be loud enough for the mic to actually pick up, but it was gonna be annoying to me, so I had to just grab that. But anyway, so coming into taking a look at the watch list this week, I did buy let's see, which ones did I buy? I bought a little bit more Hibbett this week, as well as some Tyson. I did actually buy a little bit of that ahead of doing this valuation. It's definitely come down quite a ways, and it's been some time since I picked up some of it. Not to mention, I did actually sell quite a lot of my Tyson when it was up relatively at some of the higher levels. So we've, I guess, done a pretty good cyclical buy and sell in and out of that one as over the couple years that we've been a shareholder. But yeah, so very, very curious to see how that valuation is today. I'll probably be buying more of it, I imagine, in the future, because it is one of my smaller positions. It was one of my larger positions at its peak, since now it's back to being a smaller one. Who knows, it might become a larger position once more. But I do see other stocks that have been kind of up near the top of the list that I've been kind of curious to take a look at once more. Sally Beauty has been kind of hovering here for some time, and that's another company that recently put out their 10K, so I'm very interested in taking a look at them again. Not to mention, there's the ever-present Zim integrated shipping, which I've been getting involved in some other investor groups in various other communities and having discussions about that one with some other people. And there's, further varied opinions. Not to mention Sturm Ruger. I probably wouldn't be buying into that one because I already have Smith & Wesson, but that one's still hovering up near the top of the list. So with that, we will actually just kind of get pretty relatively quickly straight into the Tyson valuation itself. I do also have the industry data sets up here, which the industry that we're mostly going to be counting them as part of is the food processing industry, though I also have the farming agriculture set up here as well. And I have the data for the global data set up here as well. So getting into Tyson specifically, if you're watching now live or on replay, I see that I'm assuming Nugget probably already gave it a like, but if you are watching on replay, please give it a like. More likes help attract people to the channel. If you're not already subscribed, please subscribe to the channel. And also the pinned comment in the chat, as well as in the description below, is the link to the Discord. Come and join the Discord, and you can be part of our community where we share daily news, have discussions about various things going on in the markets, our own portfolios, and analysis of various other companies. So come be part of the discussion there. So getting into Tyson specifically, they were founded in 1935. Major, farm producer here in the United States, meat producer, farm agriculture. I have all their main websites listed here as per normal. Their current CEO, Donnie King, is actually their new CEO that was elected relatively at the start of the year, technically through the kind of second half of 2021 to the previous CEO. There's always like the classic quote from Warren Buffett is that he likes a business where it doesn't matter what idiot runs it. And then I've also heard kind of other quotes that kind of pair alongside that, particularly from Aswath Motoron, talking about commodity companies, about how you basically would never care who the CEO of ExxonMobil is. You're only going to care about the price of oil. And so I would kind of bring that comment up here is to say that, well, with Tyson, it's somewhat similar. This is, a somewhat commodity-based company, depending on how you think of it and which section of the products. They do have prepared foods that are a little bit less commodity-like, but obviously the meats are very, very commodity appropriately priced. So there's going to be very, very little wiggle room for brand name recognition and things like that, which is why I say the prepared foods is a little bit different. So it doesn't necessarily matter too much what idiot is running the company per se. It matters a lot more about where the price of the commodities themselves are going and the overall ability to acquire, you know, the profits from those prices, which is where, you know, you need something better than an idiot. He, you know, tongue in cheek, Buffett as per the normal. But the point is we have a new CEO. It doesn't necessarily matter too much, in my opinion, who the CEO of the company is. It's really more about taking a risk reward perspective on the commodity price itself, as long as the company itself is being managed appropriately. Which, you know, we'll sort of get into that. We're talking about Donnie King, who is their CEO, but recently in the news, Tyson was kind of in the news for some of their upper management that wasn't their CEO. This is Mr. Donnie King here, but instead this guy here, John Tyson, which you'll notice that name. He is part of the founding family. But the current CFO, CFO, and as well as the executive vice president, he's the person that a lot of people have kind of pigeonholed as a potential future CEO, a future long run potential CEO. Obviously, Donnie King got the position in this last year, but this person has been kind of eyed as like a potential runner up in the future, and it partially has to do with, you know, the name attachment. He is the 4th generation member of the Tyson family, which, you know, has his own career, although it seems to be a little bit more finance focused of their career. So, you know, it's another situation of, well, maybe it doesn't necessarily matter what the specialty of the CEO is per se for the running of the company either. You know, a finance guy might be great for a commodity company. It's hard to say. But the point is, this guy was in the news because he had gotten drunk and broken into the wrong home, thinking that it was his own home, and fell asleep on somebody else's bed. And then the woman that found him there called the police on him. So there was a bit of a drop in the stock price on the report of that news, as well as, like I said, the stock had already been coming down with meat prices. But the point is, I look at that as just a free buying opportunity. What does him falling asleep in the bed have to do with meat prices? Basically nothing. So, you know, good things like that, random news stories that make people sell out of companies for no reason. I believe it only sold off a couple of percentage that particular day though, so, you know, obviously wasn't a major thing. So anyway, going beyond that, as I said, part of the food processing industry, major customers, they said, I believe in their 10K it was 17%, about 17% of their total sales goes straight to Walmart. Through their various segments, because they do sell to Walmart through all of their segments. They specifically noted that as well. As well as I listed here, Kroger and Albertsons. Obviously, Kroger is very likely about to buy Albertsons, but the point is, just, you know, grocery stores in general would be major customers of theirs, but they would have a pretty wide and deep customer base to begin with. Competitors, there's a pretty wide range of competitors that you can consider for them. Cargill, as well as Cisco and JBS, are some of the larger meat processing companies in the United States, as well as there's Archer Daniel Midlands and Hormel and Conagra, as well as Pilgrim's Pride. Those are other kind of packaged foods companies, and, you know, you could list a million more packaged foods companies, even larger ones, like perhaps even like snack food companies, like perhaps Pepsi. Even you could name a wide range of competitors to think of as competitors for Tyson. Typically, I would say more of the food processing and especially the meat producers would be the larger of the competitors, but they are trying to, you know, spread out their wings into the prepared foods, so that has to be considered as well. Suppliers, not necessarily a huge thing to think about there, other than maybe like fertilizers and things like that, farm supplies, but I didn't get deep into the weeds on that one. The next reporting date is in early February, on the 6th or so, and the call would be presumed to be coming out at that point. The filing may be a day or two later. We're not so sure about that. The revenue guidance, they guide 56 billion as the midpoint for their guidance of next year, which is they also gave a midpoint of guidance of sales of 5%. I didn't actually check to see if that 5% is specifically against the dollar amount of sales. They might be talking about volumes as far as that 5% number goes. I didn't actually back check that specifically, but they also did say 2.5 billion in capex and 320 million in interest, which that interest number was actually kind of useful to me for making certain elements of the projections. There's also the analysts off of Yahoo. 11 analysts are projecting 54.9 billion for next year as far as their sales, and then 55.66 billion according to 11 analysts for the year after that, with $6.70 adjusted EPS according to 10 analysts for the next year, and then $6.97 for according to 10 analysts for the year after that. Trailing dividend $1.84, and then they recently upped the dividend per share to 48 cents on the quarter, so now it's $1.92 per over the year, which is on the current price 2.85%. And they also have about 12 million shares authorized for buyback. They actually have their buyback listed as shares specifically, which I'm not really a fan of when companies list their buyback authorizations in shares over dollars. I prefer that when a company authorizes a dollar amount. And the reason why is because that if they authorize specifically its dollar amount, then as the company price goes up, they're inherently kind of limiting themselves in the amount of future purchases that they can make without authorizing more. Obviously, the company could just authorize more, but the point is they actually have to take a certain action to it. It sort of gives a psychological dollar cost averaging implied in there. Whereas if it's just a share amount, they're just like, well, we're just going to purchase up the shares. It doesn't matter. So, I'm not a huge fan of having just 12 million shares be the authorization, but whatever. That equates to $107 million approximately off of the current share price, and that would be 3.28% or so. And they do use their sharebacks relatively healthily or so. So I would imagine that buyback would be gone within 2 years max, probably maybe just like a year and a half or something like that. So overall, that yield of close to 6% or over 6% is probably a reasonable yield to think about as a potential forward yield. Held by insider holdings a little over 2%, and the insiders actually did increase a little bit over the last 6 months, but pretty negligible amount in the total increase. And as far as the actual holders on the actual inside holders themselves, I actually did pull open off of Ticker Terminal. They have a lot of the specifics on that, and you can see that Tyson LP, as well as John Tyson himself, that guy we were just talking about with the drinking problem. Maybe it's not really a drinking problem. Maybe it was just a drinking problem that night. I don't know. I'm not going to judge, but whatever. I've never woken up in the wrong house. That's all I'm saying. I've gotten pretty wasted, so whatever. Anyway, point is he owns about 1% of the shares himself, and then this Tyson LP, which is, I believe, of the family operation, owns about 1% as well. So that's basically the insider holding is the Tyson family. And hey, the current CFO owns about 1% of the shares, so that's nice. Held by insiders is about 86 to 87%, and the current short percentage is a little over 1%, and relative to the float, because there is a decent amount of shares kind of held by the family that are not really active per se, closer to 2%. Short ratio 1.66 days, so no major amount of pressure on the shorts currently. 3-month average volume has been 2.54 million shares versus the last 10 days has been 4 million shares. So there has been a little bit more of a higher level of volume in the last couple of weeks relative to the last few months. So with that, we'll take a look at their earnings deck, where there's actually quite a lot of interesting details to include about their brands and their segments and how they've done. How does that even happen? How do you break in by accident? I mean, it's funny because I've known somebody who did basically the exact same thing. So it's like, it sounds like a super unbelievable story, but like it's a story I've literally heard before. I had a roommate in my early 20s, and I was staying with him. Like I was crashing on his couch for like 6 months at a time, early 20s kind of stuff. And he was a total drinker. He got drunk like every night, all the time. Good guy, good friend, but man, did he drink a lot. And yeah, one night he came home super drunk and was like telling me the story about how he literally just broke into somebody's house because he had come up to the wrong place in the apartment complex. And luckily they didn't call the cops on him. That was just his luck, and he didn't pass out. It was just kind of like pounding on the door, trying to get inside kind of situation. In his situation. But yeah, he thought I had like changed the locks on him because the door was locked in his situation. I don't know the situation with Mr. Tyson, whether the door was locked or not, but he was asleep in the woman's bed or something like that was what I read. She found him asleep in the bed. So point is, people do crazy things when they're drunk. Try to keep it under control. Anyway, back to Tyson specifically. Right here, kind of showing off some of their brands, which I kind of had in the thumbnail as well. A pretty wide selection of as far as their packaged brands: Wilshire Farm, State Fair, Adels, Wright, Jimmy Dean. Across the selection, also across the different types of foods, not just lunch and sandwich type products, but also breakfast products and dinner products. And obviously, they've kind of, that diversification has kind of always been a big thing for Tyson. Their kind of big claim to fame is that they're basically the largest company in the United States that does chicken, beef, and pork. Because there's other companies that are bigger than them in beef. There's other companies that are bigger than them in chicken. But it really kind of comes down to having the claim in basically all major categories. fact, I believe it was they had. I'm pretty sure it's actually in one of these slides here. 20% of all the volumes in the United States of those three categories all combined. Anyway, getting into some of the specific stuff. Do you eat some of their stuff? Oh yeah, I mean, I've eaten plenty of their stuff at various points. I eat Jimmy Dean every once in a while. If I'm getting hot dogs, which isn't super often, I'll probably get Ballpark as the brand, but I probably don't eat hot dogs super often. I eat pet like sandwich meats and stuff. So like Hillshire Farms, that's one that I probably eat pretty regularly. I don't eat like chicken nugget stuff too often, but if I get like an oven chicken nugget thing, it might be a Tyson thing. I don't necessarily eat these ones super often, but like this, the kind of upper section up here, yeah, these are all brands that I would buy and eat. Yeah, so I mean, you know, pretty good, decent brands. But I mean, the packaged food part is also one of the smaller sections of their business, admittedly. So that's kind of just not even necessarily a huge section of the whole company. So like coming over here, comparable Q4 volumes for the upward portion of the year, as you can see right here. So in total volumes of pounds, this is in pounds. So for Q4 of 2022, they had 7 billion pounds of total volume by the company. You can see, so about 3.17 billion pounds in chicken, 1.84 billion pounds of beef. So they do a larger amount of chicken, but beef ends up being actually a larger portion of their sales, which just has to do with, you know, the price differential between beef and chicken. Are many people you know turning vegan, vegetarian? Do they eat? Do they do eggs? Yes, they do eggs, but I don't think it's. If I remember specifically, what they do is they basically kind of outsource that part out. I'm trying to remember specific details of that, but if I remember specifically, they actually work with partners for the egg products, but they do end up getting a decent amount of revenue in chicken from egg products. As far as vegetarians and vegans, I don't know too many vegetarian and vegans. I know a few here and there, but it definitely seems like something that if you spend a lot of time online, you would think that there are a lot more than they really are. It's hard to tell how much of like that stuff is really going on, because like there's still like a huge growing protein demand worldwide, regardless of, even though like some of the larger sections of the globes population wise are also relatively high in vegan and vegetarian diets. So it's like I'm not necessarily so sure that I wouldn't necessarily, I don't particularly worry about the vegan vegetarian trend per se. I don't really think that that's something that's like, I don't see like the majority of people going vegan vegetarian. I know some people that are vegan vegetarian, but not really a whole lot to make me think that like it's some growing trend per se. It might depend on like what locality a person lives in or not. Hey Fuhat, I saw you showing up in the chat there. Anyway, so getting into some of the specific, moving beyond volumes, I want to get into some of the segment specific stuff. They show themselves kind of relative to some of the other prepared food brands. Like I said, more of like packaged foods, Pepsi and Kellogg's. You can see relatively, this is just in the last 13 weeks, their overall volume growth. So they're basically talking about how good their growth has been in the last quarter or two relative to the first 2 quarters, because they actually had a little bit of a slowdown in terms of that. So you can see the dollar share growth, they've had pretty significant growth in dollar terms of their share versus competitors, 1.4% or 2.8%, but the actual pound growth, so the volume levels, has not been as good, but still relatively in positive territory. Getting into the segment that I wanted to look at. Where is that? I'm gonna move past it a little bit. Yeah, here. Okay, so getting into the segment specifically, so talking about in beef right here, beef was one of the larger sections that they had pretty strong growth in for the overall year. They got 10% in overall growth. Versus Q4, it was actually a little bit of a downtick, having to do largely with downward movements in pricings in the second half of the year, but also their operating profit came down in the segment of beef 23%, mostly due to inflationary concerns. Pork, they had much lower sense of growth overall on the year, because partially the first half of the year was much worse for pork relative to beef, and so operating profit, basically the same story, inflationary pressures and compressions of the overall pork margins. Whereas prepared foods, they actually did grow their operating profit by 16% relative to that, and I think that has to do partially just with like the branded nature of the prepared foods versus the kind of commodity nature of the pork and beef and chicken segments. So these ones having the brand names, they were able to kind of pull up the prices with the inflationary pressures relatively better. So it's one of the reasons that, having that kind of diversification into prepared foods versus just being a purely commodity operator does give them a little bit of a benefit. One thing though I would say is, like, they show here relatively high amounts of share repurchases this year versus last year. Their share price, it kind of depends on like what portion of the year you're looking at. You could argue that I didn't look at which quarters those share repurchases took place in, but overall the share prices on average have been about the same between the years. It just kind of depends on what part of the year you're looking at, because like this year we had much higher prices in the first half of the year and then much lower prices in the second half of the year, versus 2021. It was more of like a consistent upward movement in the prices. And then here's the slide where they give all the guidance that I was talking about. So with that, we'll get into the numbers for Tyson and the valuation specifically, and how that kind of breaks down into the valuation that I have. Starting with the segmentation, as I said, we're counting them as the food processing industry, and with the data set that we have for food processing companies, we find that the average unlevered beta is 0.74. So that's going to be the beta that I apply to them. For margins, you can see that the adjusted net margin has been in pretty single digits, depending on which kind of time frame you're looking at. 5.5% for the last 3 years on average, 7% for more of a 5-year average, 7% also for more of like an 8-year average. So you can kind of maybe say about 7% is a pretty consistent average for the industry. Which is something to kind of to note, because in general Tyson has slightly lower margins than that, and you can see relatively speaking they've had higher margins in this particular year, 8.6%, which Tyson's also a little bit lower in this particular year relative to the industry as well. And we can kind of compare them as well to the farming and agriculture industry, because you can see that the agriculture industry does in fact have lower margins than this. It's worth noting that this particular industry group, farming and agriculture, includes not just some actual like farming products, but also like farming machinery companies are included in here as well. So it's a little bit of a weird mixture for this particular segment, which is why we're primarily considering them food processing and not just as farming agriculture. But the point is that it does have overlap in their overall capital structure, which is why I think it's worth kind of comparing the two. And you can see that the sales capital ratios are relatively similar as well. Sales capital ratios are relatively high, so that does kind of bounce back and kind of balances out for the fact that they have lower margins. Relatively low single digit margins being balanced out for the fact that they're relatively capital efficient, which is kind of surprising considering how much land is required for the business. Is like all the processing facilities, you would almost expect them to have a relatively low sales capital ratio, but they actually end up with a pretty decent one. But anyway, sales capital ratio for the last 3 years on average, which the 3-year average is kind of what I like to rely on the most for the sales capital ratio, is 1.48. So we'll compare them to that, which for comparing them to the industry, they actually do have a little bit higher than that. As well as we can take the gross margins into account. Gross margins for the food processors, you can see here, is kind of in the mid 20s as a general average, which we can take a look at them comparative to that as well. So like I said, 1.48 for a sales capital ratio. That means $1.48 of revenue for each dollar of capital invested in the business is the average for this particular industry, and they have an average margin of 7%, and then we're using the unlevered beta of 0.74. As we were kind of talking about the disaggregation of their segments by the beef and pork and chicken, they also have international portion of their business, which really only makes about 4% of their sales, but either way we're taking that into account when applying to their equity risk premium. With that, we end up with an equity risk premium of 5.26. And then the unlevered beta of 0.74, we lever up to 0.94 after adjusting for the debt to equity ratio, which is currently about 35%. And that's off of the back of their $8.35 billion in debt, which comes in at a weighted average maturity of 12 years and an interest rate of a little over 4%, which is pretty decent terms, all considered. That's including their lease liabilities. 4%, not an amazing interest rate, but definitely not a bad interest rate at all. And then 12 years to play with, that's actually pretty great. So pretty good debt terms overall. A little bit higher debt than in general than I would like, given a few of the other features. And it's not even that much debt. That's the funny thing, but I'll get into my justification for that in a little bit. It's like 35% debt to equity ratio is not bad at all. But given some of the specific metrics, it kind of hurts them a little bit more than it otherwise could. I think that would be better if they could maybe get it down to 25%. But that has to do with their sales capital ratio, which we'll get into that stuff in a little bit. So taking a look at their financial history for the last 10 years, we'll take a look at that real quick before we get into the actual valuation. In 2013, they had $34.3 billion in sales, which grew up through the last 10 years up to 53.2 billion, 53.3 billion or so in the last year or so, which, for the first 5-year period that averaged 38 billion, versus for the next 5 years it averaged 45 and 46 billion. So pretty consistent growth throughout the period, even though they did have a somewhat of a downward movement in the revenues throughout the period. You can see they kind of moved upward through 2015, and they had a downward movement of 11%. So food prices can be somewhat volatile, and that's kind of backed up by then not having necessarily super growth because of how mature the company is going to be in the first place. So that kind of creates a little bit of some difficulties for them, and that gets into some of the costs of their operations. As we were talking about, the average for their industry in food processing was kind of in the mid 20s, 25% or so, and you can see their margins not so great, more in the kind of teens at best. We even have some single digits for the first few years here. The average gross margin for the first 5-year period and was 10%, and then for the next 5-year period it averaged 12 to 13%. So you can see there is a little bit of an improvement in the gross margins as they've kind of evolved their business over time, but either way, relatively weak comparative to their overall industry. And then that weakness in gross margins carries itself all the way down to the bottom line, which I kind of had already hinted at when talking about their industry, which is that their industry has an average net margin of 7%, whereas in the most recent year they had or let's say 7% over the longer term, and then in the most recent year it was a little over 8%. In the most recent year they had an average of 8%. Their margin was only 6%, whereas the 8-year average, which was where the 7% came from, their margin is only 5% for that. So weaker margins relative to their industry, pretty much no matter what time frame you kind of look at. But their margins have also somewhat improved over time. For the first 5-year period, it averaged 3.4% or so, and then the next 5 years, it has averaged 5.8, 5.9%. So there has been an improvement in their margins, both gross and net, over the last 10 years or so. So they've kind of, as they've grown a little bit further in their scale, made some acquisitions and dealt with some costs, they have somewhat improved their situation. But either way, it's definitely relatively slim and definitely weak comparative to their overall industry. Which, like I said, there's other factors that kind of back that up. Coming down to their cash flows and taking a look at their overall reinvestment in their business, we're taking a look at the adjusted net capex line, which is right here, which includes basically all forms of reinvestment in their business, capital expenditures, acquisitions, depreciation, amortization, as well as changeovers in working capital, all kind of boiled together into one number. See, it's actually pretty volatile over the entire time frame. Plenty of positive years, but also plenty of negative net years. The negative net years have to do mostly with depreciation and amortization, but technically if there is a spin-off at any point, which for them isn't really the case, but the point is that's another way in which it can be negative. The point is it just shows how much are they actually new capital putting into reinvest in their business versus just relying on old capital to generate future revenues for their company. But the point is over the first 5-year period, they averaged 2.2 billion per year of reinvestment in their business on net, and then for the next 5 years it's averaged 1.2 to 1.3 billion. So there's been a little bit less of reinvestment in the last few years relative to the overall kind of longer term average. And actually the longer term average over the 10-year time frame has been 1.7 billion. And then it's worth noting the most recent year they actually did 2.5 billion. So that in the most recent year they've done enough reinvestment to get them higher than the 10-year average and higher than the previous 5-year average, showing that they're actually starting to maybe turn the corner, and that they had a few years of kind of low investment, 2020, 2021, 2020 for pretty obvious reasons. And then 2021, I think it was kind of just like a hesitancy to kind of scale back up the reinvestment, but then they got a huge amount of reinvestment put up front in 2022. And then they've also laid out some of the specific plans about how they plan to do more reinvestment in the future, which we kind of already covered. They're talking about 2.5 billion in guidance for capex in this next year. So that kind of goes in line, and that would be 2.5 billion in capex, which is just one of the components of the numbers we're talking about. As I said, the adjusted net capex this year was 2.5 billion, where they actually had capex of only 1.9 billion. So it's like we're talking about a netted number that includes other things. The reason why it was so large is because they actually had to do a huge amount of investment in the working capital in this most recent year. And that's something you'd only have to do kind of on a cyclical basis. It's like you'll have to do huge investment in working capital one year, and then you probably won't have to do it again for another 2 or 3 years. And then there'll be a huge investment in working capital, and it kind of ebbs back and forth. So that one they won't have to do next year, for example. So even if they do 2.5 billion in regular capex, they'll still have it netted out by probably like 1.2, 1.3 billion in depreciation and amortization, which means that their actual reinvestment is going to go down. next year. The total net reinvestment is going to go down, even though their capex is going up, which is good for the way we are calculating the cash flows. It means their cash flows next year are likely going to be higher relative to this year. Net incomes being equal. What do you mean with investment in working capital? I'll explain that. It's reducing liabilities. It has to do with that. Working capital, as I'm sure you're at least aware of that concept, is the current assets minus current liabilities. Now, when we're talking about this particular kind of working capital, you usually don't count the cash or the debt as part of it. So non-cash working capital. And basically when a company has to make investments in that, it basically means that, like, say in 1 year, you have a certain amount of net income, and then you're in a lot of years, your cash flows are going to be equal to that. But in some years, your cash flows are going to be more than your net income. In some years, their cash flows are going to be lower than that. If your cash flows are lower than your net income, that means that you were putting money somewhere else. And that money probably went onto your balance sheet in the form of accounts receivables, in the form of inventories, in the form of other prepaid assets and things like that, your working capital. So yeah, the point is the company invests in their working capital over time, effectively by just not collecting profits, is kind of like a way that this typically happens. So like you can see, like right here, I actually have that number in here, and it comes right off of their cash flow statement. You can see, you can go to a company's cash flow statement. It'll be above the cash from operations line. It'll basically be the next section of stuff right above it. So buying machinery and stuff, no, not machinery, because machinery is going to be the actual capital expenditure, which is going to be a little bit below that, up here. So like if you go to any, this is from Ticker Terminal, but this is basically the same layout as a pretty typical cash flow statement. You have the cash from operations line. If you go straight above that, it'll show change in accounts receivable, change in inventories, change in accounts payable, change in income taxes, stuff like that. So it's basically just a bunch of bills. It's like bill collection stuff. It's not even like major plant resources and stuff, or machinery or stuff like that, because that stuff is like more traditional capital expenditure. But this is more of like kind of just extra stuff around the place. It's like, oh, this guy over here owes you a little bit of money. This guy over here owes you a little bit of money. And then inventories. Like if you have inventories, that's technically cash that's left your business, but you haven't collected the profit on it yet because you haven't sold it yet. So yeah, so working capital is another form of essentially capital expense that outside of the more traditional capital expenditure that is counted as part of cash flows. And if you look up like a pretty traditional free cash flow calculation, they'll usually include this. This is a pretty standard number. Oh, I don't know if I'm going to find like the right. I wanted a calculation of it, but I'm already on it. Yeah, whatever. I kind of just gonna rely on the explanation I already did. So yeah, over just kind of like looking here, for example, you can see in this line right here, capital expenditures over the 10-year period, they usually did on average about $1 billion in normal capital expenditures. So that's like them buying plants and property and equipment and things like that. And then they also had depreciation and amortization of $887 million. The difference between that is the net capital expenditure, which is like maybe $150 million or so. But then they also have the working capital, which is negative $306 million, which means for them, they actually spent $306 million per year by building up these resources. Do you use terminal growth rate or exit multiple? I use a terminal value. I don't use exit multiples. Lou, welcome to the stream. I don't think I've seen you here before. Yeah, this is a more traditional DCF cash flow with a terminal value, not a terminal multiple. Anyway, so coming down to the free cash flow to the equity, which basically takes into account all these forms of capital expenditures we talked about, but then also takes into account their debt issuance, which, for example, for the first 5-year period, they issued $1.7 billion per year on average in debt, and for the next 5-year period, they've actually paid down $370 million per year. So for the last few years, they've actually been lowering their debt levels on average. It's kind of been a little bit of a lumpy situation. For example, 2021 they paid down $2 billion, and then 2020 they paid down more like $1 billion. But on net over the last 5 years, It's actually been more like 400 million per year that they pay down, and that gives them to the free cash flows of equity for the first 5-year period, averaging 820 million, and then for the next 5-year period, it averaged 1 billion. So despite the fact that they were paying down debt in the last 5 years compared to the first 5 years where they were issuing debt, they actually still ended up with even higher cash flows to equity, which takes that number into account. It's the levered free cash flow. So regardless of that, though, as I say, 1 billion and then 820 million for the first 5-year period. They also had pretty significant payouts to the shareholders, and we got to see whether or not they're overpaying the shareholders. They actually paid out in the first 5-year period about 468 million per year to the shareholders versus the 800 and some that they could have paid out. So they didn't overpay their shareholders. And then for the next 5 years, it was 823 million versus the 1 billion. So not overpaying the shareholders over 5-year periods in either direction, which is good. It's what we like to see. And regardless of that, they are doing significant payouts. That comes out to being like 2/3, 75% or so, depending on the year. Like I said, very lumpy, but they're paying out their cash flows to the shareholders the way they should be, and not overpaying. So coming down to the returns on invested capital, we can see actually how these returns compared to the overall capital base that they had. For the first 5-year period, their returns on capital average about 10%. And then the last 5 years, it's averaged more like 12%, coming out to more like an average about 11% overall. So pretty decent returns on invested capital for their business. That's not exactly super amazing returns on invested capital per se. It's kind of like maybe like the minimal amount that you really kind of want to see for a really good business in the first place. Not even something super amazing, but for such a commoditized business, I would say that's pretty good. In fact, it's also good that they're increasing. So that's the thing you can see. It's like going from 10 to 12% on average over a 5-year period. It's great. And then they ended here 13, 14%, 13% again. So obviously they've had really good high prices in these years, and it's going to probably bounce back to some lower level for a couple of years. But again, looking at the average itself is climbing. And even though this is a highly commoditized business, which is pretty great. Looking at the returns on equity, similar situation. They've used leverage pretty appropriately to their advantage over the time frame. Average return on equity for the first 5-year period was like 15%, and then for the next 5-year period, it averaged 18%. So you can see that that's growing, and it's growing even more. See, like the average return on capital was 2% higher for the next 5 years. The average return on equity is 3% higher for the next 5 years. So the leveraging is also leveraging across time. It's not even just leveraging on any singular year. That the leveraging itself is compounding, which is pretty excellent. That's what you want to see. So anyway, coming down to the balance sheet, we can actually take a look at the balance sheet, which I'll kind of point out maybe some of the details as far as what I mean with the cash flows more directly from this angle as well. So looking at their cash on hand, you can see that they had like $1 billion in cash back in 2013, but then in general they had relatively low amounts of cash throughout the kind of middling years. For the first 5-year period, they averaged 587 million on hand on any given year, and then for the next 5-year period, it's averaged a little over $1 billion, 1.1 billion or so. So they've kind of been a little bit more cash heavy for the last 5 years, though admittedly you can see when that moment started. It's in 2020, so for obvious reasons, and then they bounced up to 2.5 billion, and then they've kind of been pouring cash into the business, as we talked about, in the form of all of their investment. They have a lot of cash on hand, but obviously there's kind of like a main reason for why that's happening, and I wouldn't necessarily think that that's going to remain that way. As we had also talked about, that they have been paying down their debts. So if they're using this cash to pay down their debts, and it's not just cash leaving the business kind of into the ether or into shareholders' hands when it shouldn't be, as we already discussed, that isn't happening either. So it's like, that's good. It means, in a certain sense, I almost don't care how much cash they have on hand because they are managing the assets appropriately. The thing is, when it comes to like cash in a business, it's like, if you want a company to have more cash on hand, it means that you are concerned about the risks of the leverage of their business, which we don't have that problem with this company at all. If you're concerned that a company has too much cash on hand, it's because they are either A, wasting it on things that you don't want them to, or B, not earning high enough returns on it. So again, neither of those things are particularly relevant for them. So, even if they have cash or they don't have cash, that doesn't necessarily matter too much to me. So looking at receivables, we can see that their accounts receivables are averaged 1.6 billion for the first 5-year period. And then for the next 5 years, they have averaged 2.1 to 2.2 billion. Now, this is not something that just stepped up just in 2020. You can see that they were kind of already increasing their receivables a little bit in 2019. and then they kind of increase them considerably. Now, getting back to the working capital concept, as I was talking about, Nukit, you can see right here. So if they averaged 1.6 billion and then that average went up to 2.1, 2.2 billion, that's just the average. We can just take the absolute number. The absolute number has increased. Just in the last 2 years, their accounts receivable has increased by like 600 million, and then their inventories have increased by 1.4 billion or so. So that's like 2 billion right there. See, so and that's 2 year period. We were just talking about a 1 year period, so you would have to strip out the points of it. But like, which elements of these things increased how much in the given year? Their accounts receivable have increased a certain amount. Their inventories have increased a certain amount, and when you think, this is kind of one thing you should think about, the balance sheet. The balance sheet is basically stuff that gets converted into cash later, right? Like the longer term assets is stuff that gets turned into cash in a very slow incremental basis, but the current assets is stuff that is like can be turned into cash in a more short term basis. But they can't control their accounts receivable though. No, this isn't something that you necessarily have a whole lot of control over. I'm just saying that this is something, it's just effectively how the system works. It's not like when I say you're investing in it, it's not like you're doing it necessarily in a super conscious way all the time. Receivables, you can ask for them to pay you. You can give them harsher terms to try to incentivize them to pay you. You can do small things to kind of bring in that cash flow. But in some ways, you're at the whim of the people you're doing business with. Hopefully, you're doing business with people that are going to pay you in a timely fashion. So in some ways, there's no control on that. But on the same token, it's the same thing with payables. We were just talking about net working capital. Keep in mind, net working capital means assets minus liabilities. So we're talking about the netted amount. The payables is the one that they do have more control over. Now, they only have so much control because they're at the whim of whatever terms they accepted. But in the same way that they can't control when somebody pays their bill to them, they do have some control over when they pay their bills to other people. And so if you just pay attention to the difference between the two, then you end up getting some sort of cash flow number between that. And that's what the net working capital effectively is. It's the difference between the receivables and the payables, plus the buildup in your inventories, plus the buildup in some other minor things like short-term taxes and stuff like that. So that's what I mean by a change in net working capital. It's like they're a small, See, like if you look at it from both the cash flow and the balance sheet perspective, it kind of helps to pay attention to it. It's like, look at this. It's like 2.5 billion. That's 2.5 billion in cash that they just don't have yet, versus 2.7, 2.8 billion. So that's 2.8 billion in cash that they haven't paid yet, which means on net, there's 300 billion or so in cash that they haven't paid yet, right? So you can kind of look at it that way. And if they haven't paid that 300 billion, that means their cash flow is currently 300 billion higher than it should have been. So you can see, and there's going to be an ebb and flow to that depending on the quarter, depending on the year. Net working capital, a bit of a tricky concept, but it's like I said, it's a key component to getting to the free cash flows. It's like when you're subtracting out the capital expenditures and adding back the depreciation, you should include the change in net working capital as well, which you can calculate pretty simply. Just take the net working capital in 1 year minus cash, and versus the net working capital minus cash in the next year, and just subtract out the difference. Or, like I said, you can also find the difference by looking at it on the cash flow statement. You can find the same number, effectively speaking, in here too. But you can find it in both spots. Anyway, so moving on, like I said, a little diversion on that, but it was a good point to cover. So I'm definitely happy to cover that one. I don't think I've ever covered that concept before, really, that one specifically on the channel. So pretty good to get into. Coming down to the sales capital ratio. Taking a look at their overall capital efficiency, as I was talking about, for the industry, they typically do have really high sales capital ratio. We are finding that that the industry itself was averaging, what was it? Forgot the number off the top of my head. It was averaging 1.48 in the most recent 3 years or so. So that's $1.48 for each dollar of capital invested in the business. For the last 3 years, on average, they've had $1.82. So they are more capital efficient than other competitors in their industry, even though they have lower margins, which, as I've mentioned a few times on the channel before, seeing that kind of give and take is pretty common. If you're going to have higher margins, you often are less capital efficient. If you're going to be more capital efficient, you probably have lower margins. And that's just kind of, you're probably going to specialize in one area. Some companies are best in both areas, but then those companies usually are overvalued because everybody knows it. So it's just kind of a weird take of it. But one thing you can see also with their sales capital ratio is that itself has also kind of evolved a bit over time. Their sales capital ratio was a little bit higher for the first 5 years. There was actually a relatively high sales capital ratio with a little bit of an outlier in 2013. I think they were readjusting their capital base after writing off larger investments from a few years prior to that. But either way, regardless, the sales capital ratio averaging, even if you just discount that 1 year, 2.28 for the first 5 years, and then for the next 5 years, it averaged 1.78, which is interesting to see because it actually bottomed out in 2019 and then has been climbing ever since. So I think that they went through a little bit of kind of like a longer term ebb and flow in the sales capital ratio itself. Maybe the longer term average is a little bit more representative of where they have been over the entire time frame, which itself is about $2 flat for each dollar capital invested in the business. So a pretty capital efficient business regardless. But even if I just rely on the last 3 years as an average, that still might give a pretty good indicator of future returns. So with that, we'll get into the actual projections for the future returns itself, which this is a commodity company. So we are going to take a look at the price of the commodity underlying it and taking a little bit of a look at the statistics underlying its correlation between the stock price as well as the revenues against that commodity. Now, as we've already kind of talked about, they themselves are in a group of commodities of farm products, beef, chicken, and pork. Now they get the larger section of their revenues from beef, and that's also the one that has the strongest statistical correlation. So that's the one that I'm relying on. Chicken has the next strongest, but regardless, beef is the one that seems to have the strongest one. And I'm not doing a multi-variable statistical analysis here, so you could theoretically do both, but whatever. I'm keeping it real simple. So I have these charts up here to kind of show some of what I'm talking about, and we're really only going to use so much of it. In fact, we're really just going to discuss it. I'm actually not even going to use it, and then I'll explain why in the statistics. But anyway, so in this chart right here, we have the price of Tyson stock at year end, at their fiscal year end, as well as the price of beef alongside that, which you can see there's a pretty decent amount of correlation, but not necessarily too much correlation because the stock price itself is going to go through a certain amount of compounded growth, as well as there's acquisitions going in place. So there's a lot of things that can kind of throw it off and doesn't really have that strong of a correlation per se. If we actually then narrow it down and then just take a look at Tyson's revenues against beef price, that actually looks a lot stronger if you look at it more specifically. However, if you actually break it down specifically on the year-over-year changes from each of those years, you actually find that the correlation of Tyson's revenues on a year-over-year basis to the beef price is only about 28%, which is not super strong. It's not nothing, but it's not super strong. And then the worst part, though, unfortunately, is that the explanatory factor, the R squared explanatory factor for this statistical correlation is only 8%. So it's unfortunately, even if there's a somewhat tenuous correlation between the revenues of Tyson and beef, it doesn't really have that much explanatory power. And it probably has to do partially with a small amounts of hedging that they do, not to mention a certain delay in the way the commodity prices are going to hit consumers, not to mention the diversification amongst the different products as we were just talking about. So if I did a multivariable statistical analysis, I might be able to get it better. But the point is, it's not super clean. And so as a result, I'm actually not going to rely on this statistical analysis where I would usually be pigeonholing basically a range of beef prices and then revenues based off that, which is how I typically like to do projections for commodity companies. But incidentally, it doesn't really affect the prices too dramatically. It only really increases the prices. If I use the statistical correlation, it actually increases the prices by about $2 or $3 per share, I found, across the board, because the revenues themselves don't change that dramatically from what the projections I'm going to rely on regardless. The only thing that changes is the fact that I end up with a probability distribution that's flat rather than bit more of a normal distribution, because I don't like to rely on any assumptions about the commodity. So whatever, the point is even though this is a beef company and it is traditionally a pretty commodity-based company, and in my previous valuations I have used this method for making my projections of revenues, for this particular valuation I'm just going to choose some revenue growth rates and rely on that, because basically my further growing understanding of statistics has made me decide that that's not a actually reliable way to do the projections for Tyson. So regardless, anyway, as I said, we do have the starting revenues of 53.2 billion in the most recent year. There is, as we already discussed, the analyst projections of what is it, a midpoint of about 55 billion or so for next year, as well as the Tyson guidance itself is saying about 56 billion as a kind of a midpoint. And so with that, I kind of have modified the base year to effectively get me basically that midpoint or so, which you can see right here, an expected value of about 55 billion or so for the next year, or maybe about 56. You can kind of give or take that a little bit by manipulating it, but it doesn't really change it too dramatically. And then from that point, I'm just going to have it go -5% to 6%, which is a pretty tight range as far as the potentials for it to go. That allows for it to in the worst case scenario for them to drop back basically to about their 5-year average, a little bit below their 5-year average. Which it basically allows for beef prices, in my opinion, to drop significantly in the short term, but then to kind of bounce back to some sort of midpoint in the longer term. Versus I can see them in sort of a better case scenario, them growing not quite 50%, but getting a pretty significant amount of growth in there. I kind of just chose these numbers a little bit out of the blue. It's not really based on anything too dramatic, but like I said, if I actually do put the statistical correlation in place, it actually gets me not that far of a difference in the overall revenues, and not that far of a difference in the price regardless. So I don't know, that's even with a significant difference in the overall projection. So the point is, I don't think revenues make that big of a difference for Tyson's, because it all comes down to cost controls versus the overall commodity price for them. The commodity only grows their overall base, but their ability to control prices in the face of inflation is what decides their overall value, it seems. Not to mention the capital efficiency, which is sort of what I was talking about earlier when I said I thought maybe it would be better for them to have a little bit less debt, because it seems to me that like I said, growing the revenues doesn't really help them too much as far as their overall value, partially because of the fact that they're more capital efficient than the levels of debt that they have would suggest. That given how capital efficient they are with the sales capital ratio, they should have a smaller amount of debt, because it actually costs them not that much debt, not that much in equity terms to fund the growth of their business. So anyway, with the projections of revenue, that gets us a worst case scenario of 43.3 billion, and a best case scenario of maybe about 75 billion. On an expected basis, ends up about 58 to 59 billion, which equates to about a 1 to 2% growth rate, which is, pretty minimal amounts of growth, and that's pretty much what I feel comfortable with giving them. In previous valuations, I'd give them pretty similarly small amounts of growth, and then they have significantly overshot those growth estimates for the last 2 years. And I'd much rather undershoot and then be pleasantly surprised, I guess, than the other way around. So with the projections for the margins, however, as we had already kind of talked about, they've in general always had lower margins than their industry, and I don't really expect that to be too different in the future. Now, one other thing I've kind of experienced being a Tyson shareholder for the last few years is that they do seem to have kind of some random court cases hit them, and certain lawsuits hit them every once in a while. Partially, some of them coming from different directions. They've had some previous antitrust case due to some previous acquisitions, which they did get excused, as well as they also had some employment concerns due to some wage practices, which also got excused. But the point is, it's kind of given me the belief that there's probably some other unrevealed lawsuits kind of hidden in the ether behind them. And given the scale of the company, not to mention the fact that it's a food company, which it means it's a it's a needs-based product, that the government is going to put a little bit more pressure on them relative to other less needs-based products. And so, in my opinion, even though those lawsuits kind of worked out in their favor in the last couple of years, I can see in future lawsuits maybe they don't do so well. So with that, to kind of simulate that in my numbers, I didn't really give them lower margins for that specifically, but what I did do is I actually gave them lower margins in the short term, building into the longer term margins, cutting their short term margins in half, which also is not just for that reason, but also to simulate future inflationary pressures, as we've already seen with the huge drops in their operating profits due to inflationary pressures on their operating costs in the last year. So in the short term, I have their margins being more like 2 to 3%, and then in the longer term, their margins are going to grow closer to just under 5% on a range of anywhere from 2% to 7%. And with that, those are the assumptions that get me the overall profitability. And then the capital efficiency ratio that I'm using for them is 1.5 in the worst case scenario, up to 2 on on an expected basis, all pushing it towards 1.75, and it ends up on an expected basis 1.93. So that ends up being $1.93 in revenue for each dollar of capital invested in the business. And then with that, that gets them an implied amount of default of just under 1% per year. So with that, that gets us all the assumptions that we need for the total summary. If you're watching at this point and you haven't already liked it, please give us a like. If you're watching on replay, please give us a like. If you are watching and you haven't already subscribed to the channel, please subscribe to the channel. If you've done both of those things, please check out the link in the description below, or also the pinned chat. There's a link to the Discord. You can join there to be part of the discussion. We share daily news each day, discussions about what's going on in the markets, our portfolios, and sharing our ideas related to various companies, as well as the actions of major investors in the market. So come be part of the discussion there. So TSN, Tyson Foods, US Treasury, 10-year Treasury selling for 3.9%. Mature market equity risk premium, currently 5.17% as I calculate it. Discount rate for Tyson as I come up to it with a company specific idiosyncratic risk, 8.84%. They currently have a cash dividend of 2.85%. 5 years ago, they had sales of 38.3 billion versus in the most recent year is 53.3 billion, which equates to sales growth of 6.85% per year for the last 5 years. Sales capital ratio for the last 3 years on average has been 1.93, which is a bit strong comparative to their industry of 1.48, as we had said, a bit more capital efficient than their competitors on average. Returns on invested capital for the last 3 years on average has been 11.15%, or actually that's the 5-year average. Debt to equity ratio currently 35%, and the default risk in the most recent year is less than 1%. The profit margins that they had in the most recent year is a little over 6%. Against their industry, again 7.1%, and that's actually the 3-year average for the industry. In the most recent year, the average for the industry was a little over 8%. So higher capital efficiency than their industry, but lower profit margins than the industry on average. The profit that they had in the most recent year is 3.3 million or so, and they're currently selling for $67.32 per share. Now the probability distribution that we're using for our future valuations is a little bit more tilted towards the more optimistic side of our models, the third and fourth model relative to the second model, and that gets us sales of anywhere from 43.29 billion in the worst case scenario to possibly 74.89 billion in the best case scenario. On an expected basis, we have 58.7 billion. That equates to sales growth of anywhere from -4% to possibly +7% per year for the next 5 years. On an expected basis, we see just under 2%. And that gets us a sales capital ratio of 1.5 to 2. On expected basis, we get 1.93. Our returns on invested capital overall, we see a little over 9%, which does push them over their cost of capital, which their cost of capital was actually like 7.5% or so, the weighted average cost of capital. And the debt to equity ratio, we see them keeping basically about the same debt to equity ratio overall. In fact, we see their market cap probably increasing, and then they would likely actually issue a bit more debt on net overall throughout the time frame. So we see it saying in ratio about the same. The debt default risk overall a little bit less than 1%, so pretty negligible amount of risk on overall. On profit margins, we have a distribution of anywhere from 2% to 7%. On expected basis, we see a little under 5%, and that gets us profit of anywhere from 866 million to 5.2 billion in the best case scenario. On expected basis, we see 2.8 billion or so. Using the discount rate that we have applied across the scenarios, it gets us a present value price of $80.57 per share, which is 20% higher than the current share price. 5-year forward value targets, unadjusted for the dividends that they would pay out during the period, is $45.36 in the worst case scenario to possibly $242 in the best case scenario. $123 on an expected basis, which compared to the current share price would get you an implied return of just under 13% per year. Solid business, says Newkid. Yep, that's definitely one way to put it. Like I said, I've been a shareholder of them for some time. I first started buying them literally January 2020. So right before the crash, and then I started, I'm loaded up. I loaded up during the crash. Like I said, I sold most of my position near peaks, like 75% of it. Kept a small percentage of it, because I definitely saw the potentiality for food prices to do some crazy stuff. So I was kind of like, yeah, we'll keep the exposure. And then here we are looking at it again. Like I said, I've been loading up over the last couple weeks. Probably going to keep loading up a little bit. The value score that I get for it isn't amazing relative to some of the other opportunities. That has partially to do with the fact that it doesn't necessarily have the most amazing of returns on invested capital projected, or the most amazing profit margins. And it does have a pretty wide range of outcomes, but I would say that its current price is pretty well discounted compared to those outcomes, and like I said, even though it doesn't have a great value score, I've been buying it relatively because it was such a small position. So like some of the other things in my portfolio that I consider maybe better buys were already larger positions, so it kind of ended up being like, you know what, let's just buy some more Tyson. So very solid business, very dependable business. It's not going anywhere. It's like, as we talked about, it's cash flows. They're not overpaying to their shareholders on any sort of way. So I don't see any concerns there. I would like them to maybe lower their debt a little bit, but that comes down to more just like a financial efficiency, like kind of like trying to optimize the financial metrics. It's not like they have risks or anything associated with their debt at all. It's totally safe. And as we talked about, it doesn't matter if their young CFO wakes up in the wrong bed sometimes. It probably doesn't really affect the value of the company. So yeah, that's going to do it for us today. See you next time, Nuke It. Anybody else who's in here, one last cry, please give us a like. It'd be really, really appreciated. Taking a look at what we're looking at for next future streams, I have several things kind of on the horizon. I've already been working on my Visa valuation. I did put a poll up before this stream, kind of asking what people's opinions were on. So all the things on that poll will be options again. I'll probably be putting another poll out, but a Visa, Sally Beauty, there's a few other couple ones, as well as there's probably another 10K or two that's been put out. So I don't know. Like I said, I'll probably put out a poll tomorrow to ask what people want the next valuation to be, but it might be one of those couple of companies there today. So I'll catch you all again next time. All right.